recording. All right. So we are live again. Sorry for the couple minutes of delay. We are very privileged to have James Eng of Old Capital with us to talk about what is going on with the debt markets at the moment in response to the COVID epidemic. So I'm going to turn it over to James. James, why don't you start out with a little bit of your own background, and then we can jump into what you had prepared to talk about.
Yeah, let me see if I can get this to work. Let me see if you guys can see this.
Okay.
Can you guys see this all right?
Yep.
Okay. So yeah, I mean, my background, I was born and raised in Houston, went to school in Austin at UT, did finance there, was a risk underwriter from essentially 2007 to 2015 at GE Capital. There we did everything. So industrial, office, retail, self-storage, multifamily. And then the last 5 years, I've really focused on multifamily. And so I've originated close to 800 million in debt across 125 properties. And then I also invest in multifamily properties, mostly here in Texas, DFW, Austin, and San Antonio. So I'm about 25 properties. So that's the background. I didn't know if you want me to just go through a couple slides real quick. I thought, or you want to just kick off?
Let's go into what you have prepared, and we can just ask questions. Before we go into it though, I just want to warn everybody who's watching, since James is sharing his screen, I can't see the chat. So put them into the Q&A if you have questions that you want me to ask James. Okay. So use the Q&A, and then James, I'll turn it over to you.
So this is, if you're familiar with Howard Marks, this is one of my favorite slides from his book on sort of the most important thing, which is risk. And I didn't even know, I thought I knew a lot about risk. But in one chapter, he put it this way, is our job as investors is dealing with the future. And since there's so much uncertainty with that, your job is just to control it. And so the way I look at this chart to the right-hand side, it has sort of your risk. As your risk increases, your return should increase, but it doesn't necessarily always do, right? So whenever, let's say you do a Fannie loan or Freddie loan, I would say you're right in sort of that front, maybe that second bar where someone's saying, look, you can get a 10 to 15% IRR on a deal. But then if you go further out, let's say you get a 20 to 25% IRR on a bridge loan with a heavy value add. That is true. That's the forecast, but the volatility in that risk is where I think I never thought about it as. And so to me, I think there's a shorter range on the lower risks you think about, and the higher range as you further go out, the volatility could be, yes, you do get that 20%, or you could get zero. And so I just like this as sort of a backdrop as we go through a couple of these slides. So there's another quote, sort of, you don't know where we're going, but you better have a good idea of where we are. So that's why I want to talk about where we are from Howard Marks. So this is the credit cycle. And, the first 6 stages on the top are really what during the upcycle, right? So you can think of this maybe 2013, 2014, right? So the economy is doing well. GDP has been positive. There's no really bad news. Everybody's risk sort of seems to disappear. Financial institutions provide more and more capital, right? So 14, 15, 16, there's more and more capital. And then I would say sort of this stage 6, that was probably 18, 19, and even into 20, where lenders are competing for market share by cutting interest rates, lowering credit standards, higher LTV. So think about that as IO, higher leverage, more, you're getting a bridge loan. You've only done one deal before. You don't have the experience. And then eventually that shuts off. So that shut off just a lot quicker this time. So when you see that line in the middle, so number one, losses cause lenders to become discouraged. I haven't seen losses yet. It's coming though. And then to me, we're really in that 2 and 3 stage right now, where the risk has risen, interest rates have risen, credit restrictions have risen, and there's just less capital, and only the best borrowers are going to get it. And we have not hit number 4. Number 4 is going to be in like 3 to 6 months, where this is saying companies, but borrowers are not going to be able to roll over their debts. They're not going to be able to refi. they're not going to be able to get out of their loans. And so I see us right in sort of that 2 to 3 in the credit cycle right now. And so here is I've tried to simplify everything I know about forbearance and new loans in one slide. So there's a lot of information on this slide. But the way I like to break it up is, during a crisis, number one, you have to be insulated from forces that require selling. And from the financing side, there's essentially 2 things that are going to force you to sell. Number one is you have a maturity. So you have an impending maturity in the next, let's say, 6 to 12 months. That's going to force you to sell. And number 2 is you can't make your payment. And that really leads to forbearance right now. And there's really only one positive of forbearance is you don't have to make your mortgage payment for 90 days. But you can't evict tenants. You have to pay the principal back in the next 12 months after your forbearance ends. No new loans. Fannie Mae is going to cash flow sweep everything that you have at the property. And then any tenants that are sort of COVID-19 related, Fannie is going to make you work with those tenants for up to 12 months, no late charges. And so to me, forbearance is the last option. I'd rather have you do a capital call or go to one investor, raise the money, and do it that way. On the second part of, if you're not being forced or required to sell, how can you be positioned to be a buyer? And the main loans that I see that I feel comfortable doing for people right now are really Fannie and Freddie still. And even their certainty is not 100%. So on Fannie, any loan over $6 million, they're requiring 12 months P&I, 12 months taxes, 12 months insurance, 12 months of replacement reserves. And you're going to have to put that up for you have to put it up for a minimum of 6 months. And then they're going to want 2 consecutive quarters of 125 debt service coverage. And so on a $7 million loan here in Dallas, that was about $500,000 escrow. So on a $10 million deal, essentially you're putting up 5% more in equity. On a $6 million loan on Fannie, it's 18 months P&I. So that could be over 10% of the loan amount on your escrow. Supplemental loans, so if you do assumption plus a supplemental on Fannie, you have the same requirements. And then assumptions, this is probably the one bright spot, is they are not requiring these additional reserves. So you just have your standard reserves for taxes and insurance, and you do not have that interest reserve. And then Fannie has also taken away the streamline rate lock. So before you could rate lock probably 20, 25 days after your loan app. Now you essentially have to, rate lock the week that you're going to close. And on the Freddie Mac side, it's 12 months P&I. And once the federal declarations are done, then you essentially have about 3 months where you have to require. So I think this one will come off faster, or you'll get your money back faster on the Freddie Mac small side compared to Fannie. And it's a smaller amount, it's just P&I. But they are ratcheting the underwriting up. So on refis, they're requiring 0.1 more in debt service, 5% LTV reduction, and they're requiring tax and insurance escrows as well. And then in markets like that are dependent on energy, Houston, Oklahoma, and in tourism, New Orleans, Orlando, Nevada, they are pre-screening, similar to Fannie's pre-review. So they're going to want higher debt service, lower LTV. And then Freddie Mac actually just made this change. So there's actually 12 servicers of Freddie Mac small balance. And they went back to all the servicers probably in the last 2 weeks and said, look, if any of your loans go bad, you have to buy them back over the next 18 months. And this hasn't really been reported out there. And what that has caused is lenders have added additional layers of underwriting. So whereas Freddie would have done the deal at 75% LTV, they're doing it at 70 or 65. Whereas Freddie would have done a deal in, a smaller tertiary market, these servicers are saying, no, we're not doing those deals at all. So it's an extra level of underwriting. So that's on the financing side. I wanted to throw this up there on the cycles. I think hope most people agree. But I probably see us in between sort of that fear and panic mode right now, sliding down that chart. So, the bull market, everyone's concluding everything's going to be better forever. And I almost feel like we went through the cycles of the bear market very fast. But right now, I feel like everyone's convinced things can only get worse. And so we're still sliding, I think. And this is a chart. I could probably spend 45 minutes on this chart. And this is out of Yardi. And it essentially shows the DFW through the last cycle by class. And a couple things, I think Kay mentioned this a little bit, but I mean, if you look sort of on the top end, sort of 8, 9, and 10, you saw that top end of the market got hurt a lot on the price per unit. The bottom of the market last downturn sort of pretty, I mean, there was some, it looked like 2010, there probably wasn't that many sales, but essentially stayed at like 15 a door. But look at the bottom of the market rise up in the last 5 years in DFW. I mean, essentially went from 20 a door to 70 a door. Whereas in the B market, you really saw that stay flat, not get hurt as much, but then it still made a huge run towards the end. And so, I mean, we can come back to that chart, but, and I just threw the GDP, I think, Jonathan, you mentioned this earlier, sort of GDP in the last downturn, there was probably 2 to 3 quarters there where it went negative, but it only went to negative 4%. And, you know, it's been positive since then. Here's a couple of slides that I thought just were interesting and we can talk about in a little bit more detail, but sort of vacancy. And I was gonna sort of ask Bruce, this was, when you're underwriting these broken deals, how do you sort of model vacancy? And I think, I mean, you can make your best guess, or you can sort of look historically at what it's gone to. And so, I mean, you can see C's went to 12% here in Dallas, where B's sort of copped out at 9 to 10. That's on the vacancy side. Rent growth, we saw, let's say 3 or 4 quarters of negative rent growth before it came back. And that sort of lagged a little bit. And then this was by cap rates by market. I think this is going to revert back to that expansion of, you know, tertiary and secondary because of financing in terms of cap rates. And this is just here in Dallas, but the compression in cap rates, I think it's more dramatic. This is an old chart, but I think it's more dramatic than this. I think it went down all the way to probably 5, 5.5, and 6 here in Dallas in terms of the compression in cap rates. And I think it's going to expand back up. And then here's just, this is a little bit sobering. This is from CoStar, from an old chart that I found. And essentially, like, let's say if we were in 08 in 2020, essentially there's going to be, you know, 1, 2, 3, maybe 4 years of this downturn where we're sitting before the transaction volume sort of catches back up to the peak. You know, 16, 17, I would say 18, 19, the sales volume was all probably in that range. But I think it's going to take a dive here. I mean, all transactions are pretty much shut off for the next 6 months. And so I think it's going to take a dive. I don't know if it's going to go as low as 09, but it's going to take a dive. So that's all I had. I just wanted to, I want to give you some talking points to sort of at least start the conversation, and we can go from there.
So that's great. I mean, that sets the stage really well. There's a lot to talk about there. Before we sort of dive into individual slides that you covered, I would like to just ask you what you're seeing right now. Like what's happening, you know, in real time in terms of transactions that you're working on. You know, what does the deal flow look like? What deals that were in progress when this started? What's going on? You know, just give me the picture of what you're seeing.
Okay. So let's start sort of first quarter. I probably closed more in January and February than I had previous in terms of new deals. So there was a ton of new deals that came out January, February. I had a huge spreadsheet of deals on the market. Probably 40 to 50 deals in DFW were on the market in January, February timeframe. All those deals that got under contract in January, they closed. The people who got anything after, I would say that March 13th or so, they got hit with the additional reserves. So we had deals that Fannie and Freddie had already given a commitment letter on, and they still made them put up those interest reserves. That's how strong that came down from the forces that be. The deals that, I mean, there was probably 2 or 3 deals where people were invested in final. The day before or the week before, there was one deal at 16 million, 100 a door. And essentially after Trump shut down the economy, the next best and final round was 14 million. So they took $2 million off the price because of the reserves, because of the uncertainty. And most of those deals, sellers did not take the deal. I've seen some people come back. There's one deal people were bidding on is about 30 million. Brokers started the touring process. We put in an offer at 30. The seller thought they were going to take it. They were going to probably get 31 going through the whole standard best and final process. That deal just went under contract for 28. So we're seeing about a 10% decrease right now, just off the bat. And on those deals that are happening right now, they're essentially almost all loan assumptions. And people are having to bring more equity, but they're not having to put up those reserves. And so people have been in deals for a long time. They bought a deal in 12 and they've written it out and they still have a ton of equity. They're still going to make plenty of money. They're still selling now. But if someone bought a deal like 2 years ago and they were just going to sell it because they had, pretty much doubled their money, that stopped because they're not anymore. And so they're going to hold this deal for at least 12 months, I would say, and maybe bring it out next January.
So who do you think is sort of at risk for, so I think a lot of sellers are just going to pull their deals off the market or not go to market if they were planning to, and hope that it gets better and they can get something close to the pricing that they were expecting.
Right.
But there are going to be some sellers who they just won't have a choice. They're going to have to sell. And so who is that? Like, what do those deals look like? Who are the at-risk owners that are going to be, their hand is going to get forced by this situation into selling?
So I think the first group is people who maybe bought in, let's say 17, 18. They used all their CapEx money and they do not have the reserves needed right now. And so most people, maybe they keep 1 month of expenses, 1 month of mortgage payment. They're burning that right now. And if, let's say you were in any sort of trouble, so most deals in Dallas were 90 to 95% occupied going into this. But if you were, for whatever reason, you had just changed your management company, or you had a water leak, or you had the boiler go down or chiller go down, and now you're 85 physical and now you're 65% economic, you're in trouble. And so we're starting to get those calls right now from those people because they're almost like too far. It's almost like they raised all their money in 16 or 17. They did the rehab plan, but they didn't sell it in time. And so now they're going to have to hold it for another 2 years. And they don't have the capital. So they don't have an impending maturity, but they can't make their mortgage payment. And so that's going to be a loan assumption. The question is, how much of their equity does it wipe out? Because somebody coming in now, they're going to have to carry the deal for at least 12 to 24 months, and it's not going to cash flow. So what type of discount does that person need to take? So I would say that's one type of guy. Second would be if you did a bridge loan and it's maturing in the next 12 months, you're going to have trouble. Because you probably didn't get the rents all the way there. You're probably you might be in your CapEx still. Hopefully you're done with your capital plan. But if you didn't get the rents, it's going to be hard to refi if you did 80-85% leverage on the deal. And so you're going to need a capital call, or you're going to have to just sell the deal for a loss. Bruce said, lenders probably don't want to take back all these properties. I agree with that. When I was at GE, we tried not to take back properties until it was forced upon us. So we did not take back many multifamily properties because they were still cash flowing. They were still paying the debt. Whereas we took back a ton of retail, industrial, office, because those guys they just threw the keys back to us because there was no debt. There's no cash flow to pay the debt service. Whereas I think most of the multifamily deals right now, they should have that cash flow to pay the debt service. But I'm trying to stay away from any COVID-19 or predictions. So those would be my two. I'm trying to think if there's anything else that I can think of off the bat, but those would be the two. I mean, in Texas, this is maybe why Bruce is scared of Dallas, but property taxes and insurance have flown up. And so if you underwrote taxes at 60 to 70% of your purchase price and it goes to 100, it crushes your cash flows. It doesn't matter how much you raise rents. And I mean, that's happening right now. And insurance is coming up faster. It used to be $250 a door. Now it's $450 to $500 a door in insurance. And so if you have all of a sudden flat rents or negative rents, lower occupancy and higher expenses, you're getting hit everywhere. And if you don't have any additional reserves to cover your deal for the next couple of years, that you're going to throw in the towel at some point. And I mean, this is probably the past 4 or 5 years has been sort of the rise of the syndicator. But if your general partnership, your key principals that signed on the loan don't have liquidity right now, you're in trouble.
Well, because what? Because that's who you need to turn to get liquidity to get
you
through?
Yeah. I mean, imagine, all right, imagine I'm a limited partner. I put 50 or 100 in a deal and you come back to all the limited partners and say, hey guys, we need an extra $5,000 to carry this through. I mean, I think most of them are going to look at you and be like, nah, I'm just going to hold on to the 5,000. You figure it out. So that general partner that you invested in and their key principal group, they're the first people that I think you would go to ask for money. I would start there before you send out just a blanket email to your investors and say, hey guys, we need a capital call on this deal, because they're comparing it versus what else can I buy out there? Can I just, I mean, is my 5,000 better in a new deal at new pricing, or trying to sort of rescue this deal from the bottom?
So you mentioned a minute ago, and I just wanted to clarify this because I didn't quite understand it myself, but you said you have people calling you.
Yeah.
So are they calling you because they want to try to refinance their debt to get a better debt to get them through this? Or why are people calling you? Because you're in the mortgage brokerage business. So if they're having trouble with their debt, like how do you come into this? How do you
Yes. I mean, I think I'm a little different in that, like, people are calling for advice on how do I solve this?
Got it.
And just because of, let's say somebody comes to me and says, hey, we need 300,000. We can't raise it from our key principal group. Can't raise it from our general partners. Maybe there's a third solution, right? Maybe we bring in a new general partner who's more experienced. They have a deal around the corner and they bring in their management company to take over this deal. Because the way I look at it as a mortgage broker, you know, my clients are the investors, but then my clients are also the lenders. And these lenders, we want to protect their balance sheet as well. And so we want the best possible outcome for that property. So if somebody calls me right now, and sort of like what Bruce was saying about pre-foreclosure, if I know someone's going to go down by December, I either need to restructure this debt or I need to bring in a stronger group that has the capital to take this deal over. Because most of these deals, especially if it's like a Fannie or Freddie deal, they were not over levered. It was more just operationally, they went in and executed the plan, but it didn't work, right? Whatever that plan was, or whatever that management company was, that was not the right plan. And so we need a new group to come in, and maybe that guy's equity's wiped out, or maybe, you know, they take 25 cents on the dollar, but they don't have a foreclosure on their record. So that's why people are calling right now, is saying, look, James, I need help trying to figure this out.
And how can you, are we at the stage of this yet where it is possible to try to restructure the debt, or are we just not there yet? Like, I don't
think you're there. I don't think so. Fannie and Freddie, sort of their first Band-Aid on the situation is, here's the forbearance agreement. Here's 3 months, essentially, take it. it's pre-approved to some extent, right? If you're in trouble, here's the Band-Aid, put it on. After that, that's where there's going to be more of a workout scenario. And the challenge really with the Fannie and Freddie forbearance is that you have to pay it back in 12 months.
Yeah.
That's the biggest challenge. And so some people on the single family side, or even on like the commercial bank side, let's say you did a recourse bank loan, they aren't necessarily making you pay it back right away. So maybe you pay it on the back end of your loan. And so you actually have a chance to catch up. Whereas Fannie and Freddie, you really have no chance to catch up. If you didn't get that money now, there's no way you're going to get it 3 months from now from that tenant. So you have to figure out a way to make it through the next 3 months.
So, gosh, I had a question which then just slipped my mind as I was listening to your answer. But so as unfair as this is, I'm going to ask you to kind of just think out some scenarios.
Yeah.
So let's just make the assumption that when we get the all clear that it's safe to go back to work and safe to open things up, and let's say that that's in 6 months' time.
Okay.
And there's a big rush, there's like a really sharp uptick in the economy, but there's going to be collateral damage along the way. So we're not going to come back to where we were, right? Let's just assume that we come 90% of the way back, or even 95% of the way back.
Sure.
What is the impact in that situation, in your view, on the multifamily market?
Well, I think the first thing is the next 6 months before that happens, you got to be able to survive, right? So to me, almost every investor I'm talking to is playing defense, and they're keeping their eyes out for deals, but they want to make sure they don't get swallowed up on their own deals. And so for the next 6 months, they're on defense and focused on collections. And as soon as, like in Texas, you can't evict anyone probably for the next 2 months. And so you don't have your hammer anymore. Before that was your only hammer. Now you don't have it. And so now it's sort of playing nice, right? So for the next 6 months, stimulus checks are coming, unemployment's coming. Like I didn't share the screen, but essentially anybody in Texas making less than $55,000, if they file for unemployment, they're going to make more. And so
a lot of places are like that. Yeah.
Yeah. So essentially until end of July, these people should have, let's say, $4,000 a month and their rent's $1,000. And you're asking, all right, where's the money? Right. So I think the next 6 months is collections. It's all on collections. But after that coming out, in terms of impact, I think once Fannie and Freddie see a stabilization in collections, the interest reserves will come off. And then once the interest reserves come off, then people will still be at 75 levered, but then it's still going to be 1 year VIA. And then it's going to take a while until people start doing. So even in January and February, people were $500,000 hard day one, right? Because there was plenty of lending, plenty of equity. And so I think at first, those first couple deals are going to be financing contingency, $50,000, not, refundable earnest money, right. And then slowly work its way back. It'll be interesting, a little bit more interesting to see on the Class A stuff here in Dallas. So we have probably 25,000 units that are in lease up right now. If those get leased up in the next 6 months, and at what price, and how much of an impact that has on dripping down to B. But there is a huge gap in that space. Is that enough?
Well,
I don't know what else. I don't think in terms of overall fundamentals, the multi, besides self-storage, besides data centers, I don't think there's a better place to be. And so that's exactly where I put my money over the last 5 years. And I'm building sort of like an investment philosophy for the next 5 years based on deals that go bad the next 2 years.
What do you think is going to happen with cap rates? No, you think cap rates are we're gonna go back to being the hyper compressed cap rates, or we're gonna see decompression?
I think there's at least, I think there's more, there's definitely more than 50 basis points
Of
in
decompression.
the season. Yeah, I mean, I would say I did the just back of the envelope just on deals that changed sort of from the week before March 13th and the week after, and that was like 100 basis points on cap rate.
Mhm.
And those were sort of B minus C deals, and essentially it went from 5.5 to 6.5 caps overnight. So I think that's where you are right now. You've probably already expanded 100 basis points. The problem is that there's not enough trades to really justify an average right now.
Right.
But I would say most people were probably looking for, they probably were okay at sort of low teens IRR, right? So maybe 75% total return over 5 years. Now they're 15 to 20 easily. I think I think when you go out and raise money, that's what you're going to need to justify people putting their capital in the deal.
And I'm very curious also, what do you think is going to happen with underwriting, with lender underwriting, where let's just say this goes on for 6 months and whatever the impact is going to be, we don't know. I mean, we don't know if people they're going to be like, okay, I'm making more money now, I'm going to pay my rent, or hey, I got a freebie, I'm not going to pay my rent. Or maybe there are people who, I mean, you're hearing different stories too about people not getting their unemployment checks, not getting their recovery checks. I think it's going to be all over the map, and there's going to be some impact. We just don't know what the measurement of the impact is yet, but there's going to be some impact to the bottom line because of this. When we come back, whether that's in the fall, whether that's next spring, whenever it is, and lenders are looking at these operating statements
right
for this year,
yep.
what are they going to do? Are they going to throw it all out, or are they just going to say we're only going to underwrite on T3 or T1, or like what's going to happen with underwriting? Because I'm sure that the lenders are going to be looking for more comfort rather than less, right? They're going to retrench along that risk profile that you talked about. But they're going to have all the screwy data on top of it. So what's your prediction as to how they're going to assess that situation?
So Fannie and Freddie have been the most consistent on their underwriting. So even right now, they're taking T3 for better or for worse.
Mm-hmm.
And obviously, I think they should compare it to T6 and T12. But they're almost taking, and this is how I was an underwriter when I was an underwriter at GE. This is what we did. We took a T3, T6, and T12, and we usually took the lowest and underwrote that.
Mm-hmm.
And until you see sort of a stabilization within those three metrics and you see an upward trend in collections, I think that's when you constantly just keep going. I mean, every deal the last 5 years has been underwritten on T3 net rental. And when I'm building my investment thing now, I'm saying I'm looking at T12, T6, and T3 because too many deals were sold just on T3 net rental, and that property could never sustain that. And but I think in terms of, I think the more interesting, I think Fannie and Freddie are going to stick to the 125 debt service. I think they're going to stick to the 75% leverage, and they're going to stick to a 1 year IO for a long time. The more interesting thing, and the people who got more creative on underwriting, was Bridge. So Bridge was 80% loan to cost. It was probably 4.5 to 5 all-in rates. And it didn't matter what you were buying it at. It didn't matter what your rehab was. We gave you 80%. And that I think has shut off pretty quickly. I think there are still some guys who will do it, but it's at higher rates. And they are even making you put up an interest reserve right now of at least 12 months until sort of we all get back to work. So I think for the next 6 months, if you're buying something on Bridge, you better just model in a 12-month interest reserve. And I would tell general partners who the lender's not maybe requiring 12 months interest reserve, but I would probably raise the equity to have a 12-month interest reserve in your bank account because you probably need that even maybe 24 months.
Any other advice along those lines in terms of, reserves that you should be keeping no matter what, like whether the lender is requiring it or not?
Yeah, I mean, that's what I was trying to build out is look, I mean, you got to have money for like going back to the example of let's say the deal goes bad, you got to have money for the down payment, obviously. You got to have money for the rehab and then working capital to do the rehab and then also this interest reserve. And so those were my four things that I would say you need now more than ever before. And then I'm trying to think if there's, I mean, like I'm thinking about this deal in my head that's going bad right now, and how much scrutiny they're going to get from the lender to come in and take over this deal. I mean, the lender doesn't want the deal, but at the same time, if someone's coming in and let's say the loan is $7 million and you're buying it for 7.5, and you're only putting in 500,000 as your down payment, that lender might say, well, look, I understand you're at like 95% leverage on this deal, but we're going to hold 12 months interest reserve. And I want you to have 12 months interest reserve in your bank account too. So I think some of the underwriting is going to be case by case for sure on these deals that are higher leverage than Fannie and Freddie are used to.
What about so you said the DSCRs are going to stay the same and the leverage
Yep.
amount of leverage and stuff. What do you think is going to happen with underwriting from lenders in terms of their economic vacancy assumptions? You think that will change?
So that's what's interesting is that Fannie and Freddie look at a snapshot. So they look at T3 net rental, T12 other income, pro forma expenses. So they are almost always looking at a snapshot. They're not projecting pro forma rents, better or for worse, right? So even if the chart says negative rent growth in DFW for the next year, they don't underwrite negative rent growth the same way that they didn't underwrite positive rent growth in the last 5 years. They've always based it on collections. The
Yeah.
the bridge loans are the ones that are underwriting that higher pro forma number in year 2 or year 3 for you to exit on a deal.
You didn't mention CMBS when you were talking about lenders a moment ago, and I think everyone knows that the CMBS market is kind of dead in the water right
Yeah.
now. Can you just explain that situation to people who may not be so familiar with it, and then also
Yeah.
talk about what's going to take to bring CMBS back?
Okay. So commercial mortgage-backed securities. When I was at GE, we were actually a big CMBS loan originator. And so we ended up doing office, industrial, retail, self-storage. And so GE would originate the loan and we would either package the whole thing up, just our loans, and sell it to the market into tranches. So it started at AAA and go all the way down to essentially the B piece buyer, which was the highest risk position. And but now most of the time those securitizations are put together by multiple lenders and originators. The problem is you have to have an exit, right? So GE was not comfortable holding those loans on its balance sheet until it got to the securitization. But as soon as that securitization market goes away, as soon as there's not a B piece buyer, then those spreads gap out hugely, right? So your interest rate is made up of two things. One is your base rate, which could be, let's say, the 10-year treasury, and then that spread. If that spread gaps out way too much, then your CMBS rate will all of a sudden go to 8, 9, 10%, right? And the CMBS market is not segmented by, all right, we have a multifamily guy, we have an office guy, we have a retail guy. It's all the classes. And when hotels are 0% occupied and retail only 40% of the tenants paid rent, that CMBS market, the delinquency at the beginning of this year was like 1%. Now it's going to be like 10% in CMBS. And everybody's expecting that. So the B piece buyers who are buying the most riskier piece on CMBS, they're gone. And so you don't know your rate on a CMBS deal till the very end, and you don't know if you have a deal at until the very end on CMBS. And so I've done 2 loans out of the 125 loans I've done in the last 5 years. I've done 2 CMBS loans. So for multifamily, you have the huge advantage of having Fannie and Freddie, knowing that they will be there and knowing that you get the flexibility. Whereas if you're on a CMBS loan right now, if you go to a servicer, they might deny your request for forbearance, right? Because they have to pay all the investors on the back end of these deals the amount that they're due. So they can't, the servicers actually end up paying your payment if you go in forbearance. So to me, CMBS is is a market for office, industrial, retail, self-storage. And it's at only if there is a problem where Fannie and Freddie could not do the deal for you, would you go CMBS, because there's way too many disadvantages.
I can speak to that personally because when I first got started, I could only get CMBS.
Yeah.
I was not able to get any agency stuff at all. So I went the CMBS route, which I wouldn't do again, but any port in a storm when I got started. Another question I have is what is going to happen as we emerge from this with the lenders in terms of their borrower profiles, their borrower requirements? Are they going to tighten that up, do you think? And have they started already, perhaps?
I mean, they don't have set guidelines, but let me give you an example. Let's say on Freddie Mac small balance loans. Okay, so Bruce mentioned this. Freddie Mac small balance loans, you used to be able to get all these waivers and exceptions. Waivers and exceptions were things like, okay, you live in California, but you want to buy a deal in Texas. All right, that's fine. You've never bought a deal before. Okay, that's fine. We'll do it lower leverage. All those things like that are going away. So right now in this market, they're basically shutting down all of that. So all the exceptions that lenders were making, they're taking away. And I mean, that's almost one of the reasons why Bruce said, hey, look, I'm going to make sure my deals don't go into forbearance, because as soon as you have, it's not a black mark where you were the only one who went into forbearance during this time, right? You can blame it on COVID-19 and say, hey, I went into forbearance, but they're going to remember that. And Fannie and Freddie, if they ever foreclose on you, or if you do a forbearance, they're going to make it a lot harder for you to do a loan in the future. So yes, the restrictions are to me, they're definitely going up. I mean, I think the biggest thing, this is probably what bothers me more than anything, but I don't make the rules at Fannie Mae. But one of the rules for Fannie Mae is, all right, let's say I'm buying a deal for $10 million. The loan is $7 million. You need $7 million net worth and $700,000 in liquidity. So 10% of the loan amount in post-close liquidity. Problem with that is it's not required. You're not required to hold it through the term of the loan. It's only required at close. And then that $700,000, you could have 10 deals of $7 million and it's the same liquidity. So right now, I think people are realizing that, hey, I don't have enough liquidity on my deals to support them if something goes wrong. And there's some banks, especially recourse banks, who require that in terms of the liquidity covenants. Fannie and Freddie have not. And I don't know if this is going to anyone in Fannie and Freddie, but I could see that becoming a requirement. And then if you go back to sort of 10, 11, 12, a lot of loans that were done, if it wasn't Fannie and Freddie, were bank recourse loans. And in those loans, they needed 51% of the people to sign. So anyone to get up to that 51%, all those people signed. And so these syndications were a lot smaller. And a lot more people signed, and it was recourse. And so everything was turned back down. I mean, a lot of these Fannie and Freddie deals, you're having to do, the sponsor, they only want like 5 to 10% of the equity coming from the sponsor. I could see that increasing significantly. And I mean, those are some of the things that I'm seeing is more cash in the deal from the sponsor, more people signing on the loan. And then sponsors that are close to the asset versus, in California or New York and buying something here in Texas with no experience.
What about now for all of these non-recourse with bad boy carve-outs type loans, which is probably most of the loans out there.
Right.
I guess at least theoretically, the lenders can't go after the guarantors for shortfall without triggering one of the covenants,
right?
Which generally are fraud and things like that you wouldn't expect to see just because people aren't paying their rent. But do you see lenders getting more aggressive with trying to look for triggers, or is that just something that they don't do?
No, I mean, I think it's one thing that, and I haven't really experienced this, but the worst thing that you can do is, let's say your deal is going down and you know it's going down. At that point, you need to figure out the plan with the lender and how they're going to take back that property. And you need to work with them to take back that property if you cannot sell it. I would say capital call first. Second is sell the deal. Third is work with the lender to figure out the best way to get back this property. The worst thing that you can do is cause one of those carve outs to come into play. And I think one of the carve outs is you file bankruptcy and you try to hold on to this deal. And that's when the loan actually becomes recourse. So you trigger any of those carve outs, whether it's fraud or any of those things, then it becomes recourse. And now you have a lot bigger problem than you did before. But most lenders, unless you start the conversation adversarial, then I wouldn't see them doing that. I'm trying to find a reason to take back the deal on a recourse basis and come after you personally, because I mean these loans, the guidelines are pretty similar, and all these Fannie and Freddie lenders have licenses, and if they were seen as going after somebody, they could lose their license.
So let me turn to some of the questions that have popped up in the Q&A. Okay. So Farhan asked, so he's referring to the slides you put up before about the growth in the pricing. And he says, it's fascinating to see how fast workforce housing grew in terms of price. Do you see this segment as having a drop at a similar rate where the unit price may drop back 50% again? What do you think is going to happen with pricing on these deals as a result of this?
I mean, I'm already seeing at least 10% off on those were B deals. C deals is probably 15 to 20% in distress, right? But if your tenants are paying and your tenants are able to sort of transition from the restaurant job to the industrial job with Amazon or at the grocery store, then I mean those places are full right now still. So I don't see those. I think there's going to be a dislocation right now for the next 6 months on broken deals, and there on the broken deals for sure there's going to be either there's going to be no cap rate because it's not making any money right now, and Bruce can come in and buy the deal cash, or I mean I just to get to the same return. If your return hurdle is now 15 to 20%, you just can't buy the deal on a 5 cap.
Yeah.
You got to buy it on a 6.5 or 7 cap. And, your leverage is going to be different. It's going to be lower leverage. So you just have to pay. That's the only way that you're going to raise equity, right? Like if someone came to me and they're like, hey, I got a 10% IRR deal, I'm going to probably pass on the deal right now until I see that they sort of post COVID-19 pricing, and I think they have liquidity to make it through. Because and I was going to ask Bruce this about how much in reserves should you have if you think this is going to keep going down while the knife is falling. I think Howard Marks talks about you should keep buying through the cycle because you never know when the bottom is. But then if you don't have the staying power, you get eaten up like everybody else.
Yeah, absolutely. You need to be able to survive it's different with equities than with real estate, right? Where you've got an operating business.
Yeah.
All right. So I've got another question here. I'll try to paraphrase this, but so this is from Henry. He's talking about a lot of syndicators recently closing on higher class properties, thinking that better tenant base would be less risky. But based on what you've shown in the earlier data, it seems like the A class discretionary class properties will be the hardest hit during a downturn. Is that?
So I don't think so. Most indicators that I've seen, they've moved maybe from 1980s product to maybe 90s, maybe early 2000s. They are not in the, nicest submarkets, class A, elevator, penthouse type of properties that are in lease up right now. Most indicators, they're buying deals that are still, they just, when we say nicer properties, I think most people are thinking like 9-foot ceiling, and not and washer dryer connections, and they were built in the 90s 2000s. And I think those A minus properties are actually probably one of the most well positioned right now in this market, compared to that very discretionary is sort of your A plus plus A plus stuff that is in lease up right now. And I think that's going to have some dislocation. If you come in and buy that stuff, I think that's where I get a lot of packages from syndicators, and I always had, that was my biggest concern always on the A stuff was, you just, in Texas, the state bird is the crane, building crane here is what Mark Dotzer likes to say. So whenever I looked at an A package, and I invested in a couple of deals that were a brand new construction suburban deals. And the problem we always had was, we couldn't push rents. Like, the CapEx needs were zero. So that part you've taken care of. But then your rents, you're just constantly up against new construction and lease up. And those guys have a month free or 2 months free. Like, you can't compete versus them. And until that goes away, and hopefully we see construction, obviously construction slowing through all this. But then the amount of new deals that come out of the ground, hopefully 24 to 36 months from now, are very low. So I think that's what we had. We had '08 hit hard. No banks were lending. So essentially 2 years later, in 10 and 11 and 12, there's no new construction. So hopefully that happens, and that helps all of us in the B and C space.
So here's another interesting question. I thought, how would you advise a client, a purchaser client, not a lender, if their choice was between a local full recourse, like a local bank full recourse loan, and CMBS, which would you advise them to choose? And this is a little bit abstract, a question.
That's like A, B, and I'd probably take C. But if you had only those choices, there's I would have to know the reason why Fannie and Freddie wouldn't do the deal. And if I was going to do a recourse, well, it's sort of interesting because most bank recourse loans are too small for CMBS. So CMBS, most of the time, they're $5 million and higher in loan amount. Whereas bank recourse loans are typically like the stuff that's maybe 500,000 to 3 to 4 million. So it's very rare that those two are competing. Most of the time, it's somebody going Fannie or Freddie or CMBS versus somebody doing a recourse loan, and they don't have experience, but they have a strong balance sheet, right? They were a doctor, lawyer, accountant, or something like that. And now they're coming in and buying their first deal. My biggest question, the biggest difference between those two, besides the recourse and non-recourse, is your hold period. So the recourse loan is 5 years, and you would have typically a step down prepay. So that's like a 3-2-1 step down of the loan amount, and you're out. CMBS, most people are doing 10-year CMBS loans, and they have what's called defeasance. And that defeasance is a huge prepayment penalty. And you typically have to have someone assume that loan. So to me, if you're 1 to 5 years hold period, recourse loan. If you're 5 to 10, you probably go CMBS. But obviously, need more details.
All right, and we have time for one last question before the time you've generously given us on a Saturday is up. So this question is from Hammett, and he asks, and I'm assuming this is where people have gotten into trouble with their debt. But are lenders working out a short payoff on what's due to them in place of taking the property over, or looking to sell the note at a discount? How is this going to play out?
Not yet. So we have not seen that yet. I mean, Fannie and Freddie have been pretty conservative. They were 75 to 80%, but at least collections were there. They weren't underwriting pro forma rents. So we have not seen, and plus they don't have an impending maturity, right? So most of these Fannie loans were 10 to 12 years. So even if you did a deal in 13, you still have 3 more years, right? So most of these loans don't have impending maturities. What we're seeing the most opportunity is just Fannie and Freddie loan assumptions on broken deals. In terms of workouts, it'll probably be more on the bridge side. And some of these lenders, I would say on the bridge side, they gave loans thinking we're probably going to take this one back because it was a 12-month loan or 24-month loan. And if you had one hiccup, you're in trouble. because the leverage was so high. And it was with inexperienced borrowers. And a lot of bridge lenders, they were charging, I would say, predatory rates, like 6 to 10%, the past 2 years. And because those borrowers could not get loans anywhere else at that leverage. And they essentially are going to take, the way they thought about it was, they'll pay me 10% for 2 years, and then I'm going to take back the deal.
It was loan to own is what this was.
Yeah. And so I've seen some of those, and essentially even in the uptime, with rents, with collections, we couldn't even sell it for the debt, those properties. Like the debt was so high. And so I think those are going to have to be, those people are going to take back those properties for sure.
Well, this has been really great and extremely helpful. I really enjoyed the presentation, and your slides are really interesting as well. So 2 last questions. First is, anything else you want to leave the listeners with that we haven't covered? Do you have any sort of final wrap-up thoughts or something that we've neglected to talk about?
I'm going to end with my friend Howard Marks. He said, there are old investors and bold investors, but there are no old and bold investors. So it is, investing is like a sport, right? I mean, luckily it's sort of like baseball, except you can watch every pitch go by, right? And you don't get called out. So just be ready to have your bat off the shoulder. And when the fastball comes, be ready to swing. And, a lot of times investing is not glamorous, but a lot of people make it look glamorous. And, Jonathan's been one of those guys who has sat patiently, because a lot of people have been out there just buying everything they could buy. And you have to be patient and you have to wait. And so the next 6 to 12 months, you might have to wait a little bit longer, but there are definitely going to be opportunities.
And how can people get in touch with you?
Yeah, I put my contact info in the chat, but you reach me on my cell, 214-300-5035, or email jeng@oldcapitallending.com. And then I put a bunch of stuff on LinkedIn, YouTube, and I have a website just with all the deals I've closed. You can take a look at that. It's just txmultifamily.com.
Actually, if I can grab you for one more minute, I'm sorry.
Yeah.
I scrolled down in the Q&A and saw a really interesting question. If you could just indulge me on this one. So Anna asked, so if the quarantine lasts longer in an area, or it's hit with rent strikes or rent forgiveness legislation, how are lenders planning to work with borrowers beyond the 90-day forbearance? Like what if people need more than 90 days of forbearance? How is that going to play out, do you think?
So that is they have not addressed that yet. But I think it goes to the same philosophy as you can't evict people right now until I think end of July or something like that, till the end of the CARES Act. So it is very much a relationship between you and the tenants, and you providing them a place to stay while they're in quarantine. So it's not like an office product or a retail product where nobody's using it. Like they're in there 24/7 and using all the electricity and everything that you're giving them. And so I'd be prepared to wait it out through that and try to avoid forbearance. But they have said that they would give longer forbearance on sort of a case-by-case basis. I think the initial set, just to get, it came so fast that essentially Fannie just said, all right, 90 days, like just get it out there. And that's the standard agreement. But yeah, I think if for whatever reason, if your property needs more time, I think it's a short-term Band-Aid, and you're gonna have to raise capital some way from general partners, from key principals, to sustain the deal, to bring it back and get it back online. But I think there's going to be plenty of opportunity for people out there, but definitely defense for the next 6 months if you own deals right now. But I mean, the same way, like in Dallas, all the people who came out in 10, 11, 12, they pretty much had no background previous to that in DFW. And they built huge portfolios during that time in 10, 11, and 12. So I think, if you can get out there and hustle, and you'll definitely win.
Well, once again, James, this has been terrific, and thank you very much. I really appreciate you having this chat with us. So I will talk to you soon.
All right. Appreciate it, Jonathan.
Okay.
Thanks.
Thank you so much. All right. So for everyone else, we are going